Hey everyone, welcome back to the channel. Today, we're diving into a crucial financial concept that affects your loans, mortgages, and even your investments: Canada's prime rate. Understanding the prime rate can help you make smarter financial decisions, whether you're borrowing or investing. So stick around to find out how this key rate influences both your debt and your investment portfolio. Let's start with the basics. The prime rate is the benchmark interest rate that banks use to set rates for loans, lines of credit, and variable rate mortgages. It's tied closely to the Bank of Canada's policy rate, also known as the overnight lending rate. The Bank of Canada meets several times a year to adjust this rate based on the state of the economy. If inflation is getting out of control, the Bank of Canada raises rates to cool things down. Conversely, if the economy is sluggish, they might lower rates to encourage borrowing and spending. When the Bank of Canada changes the policy rate, banks respond by adjusting their prime rate, affecting loans and investment returns across the board. In Canada, many variable rate mortgages and loans are tied to the prime rate. Let's look at a practical example. Imagine you have a 30-year, $500,000 variable rate mortgage at prime plus 1%. If the prime rate is 5%, your mortgage interest rate will be 6%, and you'll be paying around $2,974 per month. Now, if the Bank of Canada raises the prime rate by 1%, your interest rate jumps to 7%, and your monthly payments could increase to $3,293. But it's not just mortgages. Lines of credit and some credit cards are also linked to the prime rate. As it fluctuates, your interest payments on debt can rise or fall, impacting your overall financial situation. Now, what about investments? The prime rate can also influence the returns on safer fixed income investments like GICs, guaranteed investment certificates, bonds, and even high-interest savings accounts. When the prime rate rises, interest rates on these types of investments tend to rise as well. This makes them more appealing, especially if you're looking for stability in your portfolio. On the other hand, higher interest rates can cool down stock markets. When borrowing becomes more expensive, businesses may scale back expansion plans, and investors could shift to safer, interest-bearing investments. So if you're an investor, understanding where the prime rate is headed can help you decide when to focus on stocks versus bonds or GICs. Now, let's take a look at how the prime rate has changed over time. Recently, the prime rate has reached its highest levels in over 20 years, reflecting the Bank of Canada's efforts to combat rising inflation. However, it's worth noting that, in the last few months, we've started to see a downtrend in the rate. This shift could indicate a potential easing of borrowing costs in the near future. Understanding these trends can give you insight into potential future movements of the prime rate through that and how they may affect your financial decisions. Whether you're managing debt or investments, keeping track of the prime rate is crucial. For borrowers, locking in a fixed-rate mortgage or loan can provide stability, protecting you from rising rates. For investors, diversifying your portfolio with both fixed-income products like GICs and growth assets like stocks can help you weather the ups and downs of interest rate changes. By staying informed, you'll be in a better position to make decisions about both your borrowing and investing strategies. Thanks for watching. I hope this video helped you understand how the prime rate works in Canada and why it's important for both your debt and your investment portfolio. If you found this video useful, don't forget to like, subscribe, and share it with others. See you in the next one.